BlackRock just quietly moved trillions of dollars, and almost nobody noticed. No emergency alerts, no breaking news banners, no warnings on your screen. But while most investors were watching headlines, the largest asset manager on Earth was already walking out the back door with $2 trillion. Not selling in panic, not reacting to fear, but positioning before the rules change. Because when money this big moves, it doesn't chase returns, it creates them. And by the time the public understands what just happened, the opportunity is already gone. Stay with me, because in the next few minutes, you'll see where that money is going and why this move signals the largest wealth transfer of our lifetime. Welcome to Market Metal. If you've lived long enough to see markets rise, crash, recover, and repeat, then you already know something most people don't. These moments don't come with invitations. So if this feels like a calm conversation before a storm, go ahead and subscribe. Not for noise, but for clarity. And take a second. Tell me in the comments where you're watching from today. Let's begin. The move that didn't make headlines. The most important financial events rarely arrive with sirens. They do not interrupt programming. They do not trend for days on social media. They do not come with bold headlines warning people to pay attention. Instead, they happen quietly, buried in filings, portfolio adjustments, and allocation reports that only a few people ever read. This is exactly how the latest move by BlackRock unfolded. While markets debated daily price swings, inflation prints, and political drama, BlackRock quietly shifted roughly $2 trillion of exposure away from the United States and toward non-US and emerging markets. There was no press conference, no dramatic announcement, just a reallocation of capital on a scale large enough to reshape global markets. To understand why this matters, it is necessary to understand who BlackRock is and how it operates. BlackRock is not a hedge fund chasing short-term trades. It is not a media personality making bold predictions. It is the largest asset manager on the planet, overseeing roughly $14 trillion in assets. That capital sits inside retirement accounts, pension funds, sovereign wealth portfolios, insurance balance sheets, and institutional mandates across the world. When BlackRock adjusts exposure, it is not making a guess. It is executing a probability-based decision grounded in policy analysis, currency dynamics, and long-term return expectations. A simple way to think about it is this. If the global financial system were an apartment building, BlackRock would be the landlord. It owns a piece of nearly every floor. It is embedded in stock indices, bond markets, private credit, commodities, and alternatives. When an entity like this moves capital, it is not reacting to fear. It is responding to structural conditions. This distinction is critical. Most investors focus on price. They watch charts move up and down and assume that price tells the full story. Institutions, however, focus on capital flow. Price can be noisy. Capital movement is intentional. When trillions of dollars shift quietly, the signal is not volatility, the signal is direction. The move itself did not mean that the United States was collapsing or that American markets were about to fail. That is not how institutional reallocations work. Instead, it signaled that expected returns were changing relative to risk. Capital, like water, always seeks the path of highest efficiency. When the terrain changes, the flow adjusts. One of the reasons this move went largely unnoticed is because it did not involve dramatic selling. There was no visible panic, no sudden liquidation across U.S. markets. Instead, the shift occurred through gradual rebalancing, reduced marginal exposure, and increased allocations elsewhere. To the casual observer, nothing appeared wrong. To institutions, everything had changed. Retail investors tend to react to headlines. They buy when the news is positive and sell when it feels frightening. This behavior is emotional and backward-looking. Institutions operate differently. They move before the headlines exist. By the time financial media explains a trend, that trend is already mature. The best returns have already been captured. This is why the silence surrounding the BlackRock move matters more than any headline ever could. $2 trillion is not a symbolic adjustment. It represents a strategic decision that future growth, on a risk-adjusted basis, is more attractive outside the United States than within it, at least for now. Markets do not reward loyalty, they reward positioning. Capital does not care about national pride, it cares about future speed. The real danger for individual investors is not that BlackRock moved. The danger is not knowing why it moved. The reasons are not hidden, but they are often misunderstood. First, currency matters. Over the past year, the US dollar has lost meaningful purchasing power. Even if a portfolio showed positive nominal returns, investors often became poorer in real terms because their dollars bought less. Institutions are highly sensitive to this. Preserving purchasing power is a core mandate, especially for pension funds and sovereign entities that cannot afford long-term erosion. Second, relative performance matters. While U.S. equities continued to rise, they did not dominate global returns the way they had in prior cycles. Several international markets significantly outperformed. When this happens alongside a weakening domestic currency, foreign assets receive a natural boost. Investors benefit not only from rising asset prices, but also from currency appreciation relative to the dollar. This creates a double return effect. Third, policy risk matters. Markets dislike uncertainty not because uncertainty guarantees losses, but because it increases volatility and reduces predictability. Shifts in trade policy, regulatory posture, and fiscal direction all add friction. Large institutions respond by reducing concentration risk. They do not wait to see how events resolve. They reposition while probabilities are still mispriced. It is important to stress what this move was not.
It was not a prediction of an imminent U.S. collapse. It was not an abandonment of American innovation. The United States remains dominant in technology, defense, and artificial intelligence. Those strengths have not disappeared. However, dominance does not guarantee the highest marginal return at every moment in time. Global leadership rotates. It always has. Every major wealth transfer in history occurred quietly at first. The British Empire did not collapse overnight. Capital simply began to flow elsewhere. Industrial leadership did not disappear suddenly, it migrated. Those who watched capital flows adjusted early. Those who waited for certainty arrived late. This is why understanding institutional behavior matters more than following narratives. Institutions do not predict the future. They assign probabilities. They respond to shifts in data, not emotion. They understand that certainty is expensive. By the time certainty appears, the opportunity is usually gone. The average investor often waits for clarity. They want confirmation. They want the news to say that everything is safe. Unfortunately, safety and high returns rarely coexist. When the world feels calm and obvious, assets are usually fully priced. The quiet nature of this move is the warning. When trillions move without noise, it means the system is adjusting in advance. It means the transfer has already started, even if it does not yet feel real. Wealth transfers do not announce themselves. They unfold slowly, then all at once, and only afterward do people realize what happened. This first part establishes the reality. A massive reallocation occurred, driven by structural forces, not fear. The next question is unavoidable. Why now? Why did capital begin rotating at this specific moment, and what pressures are pushing it away from the United States? Those answers reveal whether this is a temporary adjustment or the early stage of a much larger shift. That is where the analysis must go next. Why capital is leaving the United States now if the first question was what moved? The more dangerous question is why it moved now. Capital does not relocate without pressure. It moves when staying put becomes inefficient. For institutions managing trillions, inefficiency is risk. And risk, when multiplied by scale, becomes unacceptable. The timing of this shift matters. For years, the United States enjoyed a rare position. It offered strong growth, deep liquidity, global trust in its currency, and policy stability relative to the rest of the world. Capital concentrated there because the math worked. That math has started to change. The first pressure point is the U.S. dollar. Over the past year, the dollar's purchasing power has weakened in real terms. This is not a political statement. It is arithmetic. Inflation, deficits, and interest rate dynamics have reduced what each dollar can buy. For households, this shows up at the grocery store. For institutions, it shows up on balance sheets. Large investors do not look at returns in isolation. They look at real returns. If an asset gains 15%, but the currency loses 8% of its purchasing power, the real gain is much smaller than it appears. When that pattern persists, capital begins to search for alternatives. At the same time, performance outside the United States quietly improved. Several international equity markets delivered stronger returns than U.S. benchmarks. This was not a one-week anomaly or a speculative spike. It reflected structural differences. Productivity gains, policy reforms, and demographic trends created growth where expectations had been low. When growth surprises to the upside, capital notices. Now layer currency on top of that. When the dollar weakens, foreign assets gain an additional tailwind. Investors benefit not only from rising stock prices, but also from favorable exchange rates. This creates a compounding effect. Institutions refer to this as currency-assisted return. It is one of the most powerful drivers of global rotation cycles. The second pressure point is policy uncertainty. Markets do not fear change. They fear unpredictability. When rules feel unstable, capital demands a higher return to stay exposed. If that return is not available, capital leaves. Political cycles amplify this effect. Trade policy debates, tariff discussions, and regulatory shifts create uncertainty that cannot be modeled precisely. Institutions respond by reducing concentration. They spread exposure geographically, not because they expect disaster, but because they expect volatility. This is where retail investors often misunderstand institutional behavior. Retail investors tend to ask, is the U.S. market bad? Institutions ask a different question. Is the U.S. market still the best place for marginal capital right now? Those are not the same question. The answer does not need to be negative for capital to move. It only needs to be less positive than alternatives.
The third pressure point is valuation. After years of strong performance, many U.S. assets reached elevated valuation levels. High valuations do not guarantee a crash. They do, however, reduce future expected returns. When expected returns compress, institutions look elsewhere to rebalance opportunity. This is not market timing. It is portfolio math. At the same time, many non-U.S. markets remained underowned. Capital had avoided them for years due to slow growth narratives, demographic concerns, or outdated assumptions. When fundamentals improve while ownership remains low, the return potential increases sharply. This creates a classic setup for rotation. Capital leaves where expectations are high and enters where expectations are low but improving. This is how institutions generate asymmetric returns without chasing momentum. Another factor quietly influencing this shift is demographics. The United States is aging. An aging population spends differently. It saves more and consumes less aggressively. That does not stop growth, but it changes its pace. In contrast, several emerging and developed non-U.S. economies are experiencing younger workforce expansion or productivity-driven reform cycles. Young populations work, they build, they consume, they innovate. Over time, this changes growth trajectories. Institutions track this closely because demographics are slow-moving but powerful forces. Then there is the issue of capital flow psychology. Large investors do not wait for consensus. In fact, consensus is often treated as a warning sign. When everyone agrees on an outcome, prices usually reflect it. Institutions prefer environments where disagreement is high and visibility is low. Right now, many investors remain heavily concentrated in U.S. assets out of habit, not analysis. This creates crowding. Crowding increases risk because exits become narrow. Institutions reduce exposure before those exits are tested. This is where the suspense builds, because from the outside, nothing looks broken. Markets still function, indices still trade, headlines still rotate daily. Yet beneath the surface, capital is already repositioning. This creates a lag between cause and effect. The longer that lag persists, the more violent the adjustment can become when it finally shows up in prices. One of the most misunderstood elements of this shift is the role of fear. This move was not driven by panic. Panic creates sharp, visible moves. This shift was calm, methodical, and distributed over time. That is how professionals operate. They move when no one is watching. Retail investors often interpret calm markets as safety. Institutions often interpret calm markets as opportunity to reposition quietly. This inversion is critical. The wealth transfer does not begin when prices fall. It begins when capital changes direction. Prices follow later. There's also a global context that cannot be ignored. Governments around the world are competing for growth, capital, and influence. Industrial policy, supply chain realignment, and strategic resource planning are reshaping where money flows. Institutions respond by aligning portfolios with future centers of production, not past centers of consumption. The United States remains a major player, but it is no longer the only engine. Capital is adjusting to a multipolar growth environment. This is uncomfortable for many investors because it challenges familiar assumptions. For years, the dominant strategy was simple: stay invested in U.S. markets and wait. That strategy worked exceptionally well. When strategies work for a long time, they become beliefs. When beliefs harden, adaptation slows. Institutions cannot afford that mistake. They do not fall in love with markets. They do not defend narratives. They follow probabilities. When probabilities shift, portfolios shift. The most dangerous moment in any rotation is the middle. At the beginning, only a few notice. At the end, everyone talks about it. In the middle, confusion reigns. Prices do not yet reflect the new reality, but capital is already moving. This is where mispricing is greatest and risk is highest for those unaware. This is where the current environment sits. The rotation out of the United States is not a rejection. It is a recalibration. But recalibrations of this size change the opportunity landscape for years, not weeks. The next question becomes unavoidable. If capital is leaving one area, it must be entering another. Institutions do not pull money out to hold cash indefinitely. They redeploy it where the math improves. Where exactly is that money going, and how do institutions express those positions without attracting attention? That is the part of the story most investors never see until it is too late. Where the money is going, and why it looks invisible at first. When capital leaves one place, it does not disappear. It relocates. This is where most investors lose the trail. They expect to see headlines announcing where the money went next. They look for dramatic rallies or obvious winners. But institutions do not move that way. They do not announce destinations. They use instruments designed to hide intent while building exposure. That is exactly what is happening now. After reducing exposure to the United States, institutional capital began flowing into non-U.S. markets through broad, quiet, and flexible vehicles. Not single stocks, not flashy trades, but diversified structures that allow scale without attention. The first thing to understand is how institutions express conviction. Retail investors often pick individual companies. Institutions think in systems. They ask which regions, demographics, and productivity engines will benefit most from the next phase of global growth. Then they buy access, not stories. That access usually comes through exchange-traded funds. ETFs allow institutions to deploy billions without distorting individual stock prices. They offer liquidity, diversification, and speed. Most importantly, they allow capital to move before narratives form. One of the earliest beneficiaries of this shift has been emerging markets, not because they are fashionable, not because they are risky, but because they are underowned and improving at the same time. This is a powerful combination. Emerging markets represent countries with growing populations, expanding middle classes, and rising productivity. These are not abstract concepts. They translate directly into consumption, infrastructure, and corporate earnings. Institutions track this carefully because demographics change slowly but predictably. When a country has a young workforce, that workforce builds, spends, and innovates. Over time, this creates internal demand and external competitiveness. Several emerging economies are now entering that phase simultaneously. Institutions gain exposure to this trend through broad emerging market ETFs rather than betting on any single country. This reduces political risk while preserving upside. It is not a gamble. It is a calculated allocation to future growth. What makes this move particularly subtle is timing. Many of these ETFs are not surging dramatically right now. Price action appears calm. To retail investors, calm looks boring. To institutions, calm looks like accumulation. Professionals do not chase assets after large rallies. They build positions when volatility is low and attention is elsewhere. This is how they avoid paying premiums. Another destination for capital has surprised many observers: Japan. For years, Japan was treated as a stagnant market. Aging population, low growth, deflationary history. Most investors wrote it off and moved on. Institutions did not. They waited. Japan has been undergoing a structural reset that rarely makes headlines. Corporate governance reforms, efficiency improvements, and a renewed focus on shareholder returns have quietly changed how Japanese companies operate. This is not a cyclical rebound. It is a re-engineering of incentives. At the same time, Japan's currency weakened. This created a powerful export advantage. Japanese companies became more competitive globally, while foreign investors benefited from currency-driven return potential. When institutions saw governance reform aligned with currency tailwinds, capital began to move, not all at once, quietly. Again, ETFs provided the mechanism. Broad exposure to Japanese equities allowed institutions to express conviction without betting on individual outcomes. Liquidity remained high. Attention remained low. Then there's the most telling allocation of all, the global basket. When institutions believe growth will be faster outside the United States as a group, they do not need to pick winners. They buy exposure to the world itself. This is the purest form of a macro bet. Global emerging market ETFs spread risk across regions while capturing the overall acceleration of non-U.S. growth. This approach reflects confidence in a structural shift, not a short-term trade. The performance numbers confirm the logic. Several of these global and emerging market exposures delivered returns that exceeded U.S. benchmarks over the past year. This happened while ownership remained relatively low. That combination is rare. High returns usually attract attention quickly. In this case, the move stayed quiet. Why? Because narratives lag capital. Media focuses on what already moved dramatically. Institutions focus on what is about to matter. By the time an asset class dominates headlines, it is often too late to enter with favorable risk. This is where suspense deepens. Because while many investors are still debating whether diversification makes sense, the diversification has already begun. The question is no longer if capital is rotating. The question is how far along that rotation already is. Institutions understand something that retail investors often overlook. Global growth does not need to be perfect to outperform. It only needs to be better than expectations. Right now, expectations for non-U.S. markets remain modest. Expectations for U.S. markets remain high. That imbalance is where opportunity lives. Another reason this shift feels invisible is because institutions are patient. They do not need immediate gratification. Pension funds, endowments, and sovereign wealth entities think in multi-year windows. They are comfortable sitting through flat periods if the long-term math improves. Retail investors often abandon positions during these quiet phases. Institutions build them. This creates a delayed reaction effect. When the benefits of these allocations become obvious, prices adjust quickly. At that point, retail investors rush in seeking confirmation. Institutions are already positioned. This is how wealth transfers occur without drama. But there is an even deeper layer to this shift that most investors completely miss. It is not just about equities. Alongside this global equity rotation, institutions are adjusting how they protect capital during uncertainty. They are not relying solely on diversification anymore. They are adapting to changes in the rules of the financial system itself. This is where the story turns from allocation to architecture. Because while capital flows into emerging markets and global baskets, another asset has quietly changed status, not in price terms, but in function. That change affects balance sheets, collateral, and liquidity across the entire system. It alters how banks operate and how crises are absorbed. Most investors only notice it when prices spike. By then, the rules have already changed. The next part of this story is not about where capital is going geographically. It is about where capital is going structurally. It explains why certain assets behave differently during chaos and why institutions are preparing for scenarios that have not yet entered public conversation. This is the shift that turns a rotation into a true wealth transfer. And it is happening in plain sight, while most people are looking somewhere else. The rule change that turns. Rotations into wealth transfers, approximate 1,100 words, third person, Artas analytical high suspense briefing tone. Every major wealth transfer has two phases. The first is visible. Capital rotates from one region to another. Markets debate performance. Commentators argue about growth and valuations. This is the part most people see. The second phase is quieter and far more dangerous. It is when the rules of the system itself change. That second phase is now underway. While investors focus on equities, currencies, and politics, institutions are preparing for something deeper. They are positioning for a world where financial stress is absorbed differently, where liquidity behaves unpredictably, and where traditional safety assumptions no longer apply. This is where the story stops being about geography and starts being about architecture. For decades, certain assets existed on the sidelines of the financial system. They were stores of value, not tools. They were held for comfort, not function. In times of crisis, they protected wealth, but they did not actively participate in the machinery of finance. That has changed. Quietly, and with little public discussion, gold has been reclassified in how major banks treat it on their balance sheets. It is no longer viewed as deadweight. It is now treated as a top-tier liquid asset, comparable to cash for regulatory and collateral purposes. This sounds technical, but the implications are profound. When an asset can be counted as high-quality collateral, it becomes leverageable. Banks can use it to secure funding, manage liquidity, and expand balance sheets. In plain terms, gold has shifted from being a passive hedge to an active financial tool. Institutions noticed this immediately. This is why gold prices reached new highs even when fear did not appear extreme. The move was not emotional, it was functional. Demand did not rise because people were scared. It rose because the utility of the asset changed. When the rules change, capital moves before the explanation arrives. This rule change matters to everyone, including those who have never owned a single ounce of gold, because banks sit at the center of the system. When their collateral rules change, lending behavior changes, Liquidity distribution changes, risk transmission changes. In other words, the plumbing of finance adjusts. This is why institutions are pairing global diversification with structural hedging. They are not betting on disaster. They are preparing for volatility that does not behave the way it used to. At the same time, they are well aware of how markets manage human behavior during periods of stress. There is a pattern. It is consistent. It repeats. Uncertainty is introduced late in the week. News breaks on Friday evenings or over weekends. Details remain vague. Investors are left alone with anxiety for 48 hours. Social media fills the gap with speculation. By Monday morning, fear is elevated. That is when selling pressure appears. Institutions understand this pattern. They have studied it, they exploit it, they buy when emotion overrides analysis. Then, as the week progresses, negotiations emerge, statements soften, and markets stabilize. By the time clarity returns, prices have already adjusted. This is not conspiracy, it is behavior. Markets are designed to extract emotion. Algorithms amplify volatility. Alerts flash red. Constant updates prevent reflection. The goal is not information. The goal is reaction. Retail investors often confuse activity with action. They feel compelled to do something. Institutions feel compelled to do the opposite. They wait, they observe, they act only when probabilities align. This is why the wealth transfer accelerates during periods of chaos, not because chaos creates opportunity by itself, but because chaos forces mistakes. Wealth does not disappear, it changes hands. Those hands belong to whoever can stay calm when the system becomes loud. This is where the final warning becomes clear. Waiting for certainty is not caution, it is risk. Certainty arrives only after markets have adjusted. By the time outcomes feel obvious, prices already reflect them. The premium has been paid. The transfer is complete. Institutions do not wait for confirmation. They respond to shifts in probability. They understand that discomfort is part of the process. Every rotation feels wrong before it feels right. This does not mean abandoning the United States. It does not mean panic selling. It does not mean chasing trends. It means awareness. It means recognizing when capital flows change direction. It means understanding that diversification is no longer optional in a multipolar world. It means respecting that structural rule changes matter more than short-term narratives. The greatest risk is not volatility. The greatest risk is ignoring silent signals. When the largest asset managers on Earth reposition trillions without noise, they are not making a statement. They are executing a strategy. That strategy reflects expectations about growth, currency, policy, and system resilience. The wealth transfer does not begin when prices collapse. It begins when rules adjust and capital moves quietly. By the time it becomes obvious, the window is already closing. This is the final truth of the moment. The system is not breaking. It is evolving. Those who adapt early will not need to chase returns later. Those who wait for comfort will inherit uncertainty. The transfer has not ended. It has only just been triggered.